Now my two questions, and we're going to go through the panel in the beginning, are what's working, what's failing, and why? You know, what has traction, what doesn't have traction, and why? So let's just start with you.
Sure. Yeah, good morning, everyone. So what's working? Unfortunately, there's a lot more working in fintech than not. That's somewhat of a relief, notwithstanding some of the recent volatility and sentiment in the space. From an investor's point of view, I think a couple things that are surely working is that the bravado of fintech has subsided a bit. You know, the rally cries to displace the banks and displace the financial institutions that are incumbents, those have subsided. And I think that has allowed for a more rational conversation as investors. I think secondly, I think the market has begun to discern between the truly disruptive companies and the Me Too companies that are probably more point solutions than anything else. So that's kind of a macro from an investment side. So no doubt some of the tourists, fortunately, have been scared away over the last few years because of some of that sentiment change.
So because I'm a reporter, I'm kind of a jerk. I want everyone to be really specific. Yeah. What is failing? Why is it failing? What is working?
Yeah, sure.
Not from a macro point of view, but what really is.
Let's go down deeper then. So what's working? At a minimum, a couple things have been achieved. I think you have traditional financial services companies, take banks, for example, or insurance companies, been forced to rethink their businesses and fundamentally innovate. They've done so by partnering with existing fintech companies. It's spurred their own captive innovation. They have venture groups being set up. They have collaboration centers. So there's more testing and learning than ever before. So I think that's a wonderful thing. I think secondly, you have, from the consumer, has really been the biggest beneficiary.
I just want to know what's working and failing. So
okay, so what's working is consumers are now getting better access to product at a more convenient fashion, at a fundamentally lower cost, and there's a lot more transparency. That is working. What's not working, I still think, is that there is a dearth of harmonization and regulation between those, how it gets applied to traditional institutions, and those to the more non-bank companies. Because I'm sympathetic to the regulators in terms of this pendulum where, on the one hand, they want to foster innovation and access, but offset by this paternalistic view against taking too much risk. And I think as a result of that, it has left us in a bit of a limbo stage where you have a lot of non-bank companies operating in a somewhat nebulous regulatory environment, and they find themselves begging for forgiveness afterwards, and you have a lot of the traditional institutions asking for permission. And that has fundamentally stalled innovation within the four walls of the large ones, large companies. But on the flip side, it has fostered it. Now, how do you get them to work together? I think ultimately it requires more harmonization. I think that's where we failed thus far.
So I'm going to keep pushing for more granularity, because rather than so let me go to you. And can you you invest both in Europe and in Africa? What are the things that you've tried that have actually worked? What are the things that you have seen that have failed? And I say this with the idea that a lot of great ideas don't always pan out, and a lot of unconventional things that may not seem like great ideas sometimes do really work out.
Okay, first, welcome everybody. My problem is that I agree with Jonathan in a lot of stuff, so I just repeat it because I think in general, and then I come to a detailed answer, it's the two things. I call it, what do you say, point solutions is what I call apps. So there are a lot of interesting ideas where we all would like to use, but which are not big enough to be a business model. They are nice applications an existing bank might use. Like, for example, I do not believe, especially in Europe, I think here it's a little bit, I have the European view. Here it seems to be a little bit different, but I didn't look at all the robo-advisors here. But I think 95% of the robo-advisors in Europe will die because it's a nice gimmick and a lot of banks should have it for their clients, but it's not a standalone business model. And maybe one of them makes it, but in Europe we have at the moment, in Germany we have 20, so I guess there are like 50 in Europe, and it's absurd. Meaning, and they have.
Why is it not a standalone? I mean, we just had a panelist who was really defending robo-advisors.
They have tiny margins, which is good for the consumer, because they really like cheap products, but you need a lot of assets. Then you have 50 or more companies battling for the assets. And then what I always say is I have the feeling there is sort of a Stockholm syndrome in financial services. Yes, every B2C, especially every robo-advisor tells me on the first slide, retail clients are unhappy with the banks. And I would say we can all agree with that. But when you then dig in, how many retail clients do really change from a normal traditional bank to a fintech startup? Nobody, or tiny, tiny, tiny. So the market they are all targeting is tiny, and they would all need 100% market share in order to make profits. It just doesn't, meaning at least in Europe again, it doesn't make any sense. Yeah, and most of them will be bought somewhere by banks because it does make sense for an existing bank with existing clients to apply a robo-advisor on their clients. So my best deals actually have been when I took control of existing smaller banks or existing financial services companies with a lot of clients. For example, I bought the largest insurance and investment advisory business in Europe, in Germany, with like 16,000 advisors and 1 million retail clients, totally old-fashioned. And then I put a robo-advisor on that company. Yeah, so we practically from the start had 1 million clients, 6 billion assets, and that worked. Yeah, tremendously. We make now, when I came in, they make like 2 million profits. Now they make 10. Yeah, because it's really scalable now. Yeah, but it's sort of a hybrid.
You look very eager to start with this.
No,
yeah,
we're
very interested.
I would, before you ask me the question again, I think that you're absolutely right. And I think that what is different and unique about financial services than probably any other industry, certainly in the venturing space, is that because of the inability to innovate in large scale in the large organizations, you need to have these startups emerge outside of the bank in order to actually allow them to grow. They may or may not grow to a point where they can become an established company, but they will be the innovators who create the tools, the bells, the whistles, the stickiness for the banks that ultimately will come and take them out.
Have you seen examples of that?
Yeah, and I think we're already starting to see there's a handful of, we've already seen it in the challenger bank world, right, with Fedor being acquired by BBVA a few years ago, or sorry, Simple being acquired by BBVA and Fedor just recently being acquired. So a lot of the challenger banks have built some technology and built some businesses that stand alone may not work, but inside a larger organization could, right? One of the other things that I think is not working, which then leads to some of the collaboration that is working, is traditional corporate bank venturing. It is a very difficult thing, and every single bank out there right now has or is starting to have a large-scale venture arm. But venturing, first and foremost, is not necessarily just investing. It takes a very specific type of thesis, it takes a certain type of personality, and it takes a certain amount of diligence in a marketplace to be able to truly find some of these early stage companies. And banks cannot move at the speed and the nimbleness that is needed for the early stage transactions to have. So I think a lot of money that flowed into the industry early on, and when everyone said there was tons and tons of capital to be had, it was about sort of where that capital was coming from. Because if a bank, sometimes it's harder to write a $500,000 check at a bank than it would be to write a $50 million check. And I think more and more of these corporate venturing arms are realizing that. And so they're tweaking their models. They're going further down the capital scale. They're doing B and C rounds and looking for partners in the early stage.
That's what you're doing.
We're doing that, yeah. And we're working very closely with banks because of that. And it took about a year and a half of recognizing this moment of we can do it ourselves versus the actually, if we're Citibank, and not to pick on Citibank, but if you're looking at an entrepreneur who wants to put Citibank out of business or wants to disrupt Citibank's core business, why would they take their first check from Citi Ventures, right? It's a very difficult thing to do. And so the partnering and the collaboration that's occurring between venture capitalists and large-scale financial institutions makes a lot of sense because we can get there together, but do it later.
Could you, without disclosing anything you don't want to disclose, but if you had, you have how many investments? You have.
We have just north of 40 investments.
Are there a couple that you're talking about that you may have written a $500,000 or $1 million check that you think is really interesting that kind of fits into this that Citi couldn't do it, but you can, but maybe one day it may be more valuable for Citi to spend $50 million than $500 million because they couldn't do it at $5.
Yeah, well, we can take an example of something that's in our portfolio and that's moving at a nice clip. The company Trove out in the Bay Area, and they do sort of just-in-time insurance premiums. And when Trove started, they were a company that wasn't on anybody's radar screen. And we found them in large part because we had a handful of large-scale insurance companies who recognized that there was a massive problem that they were trying to solve for, and they couldn't solve for it. They didn't know how to do it internally. They didn't know if there was anything in the market that existed like that. And so they asked us if we had any thoughts. And so our investment team went out and started to scan the market for this particular thesis, and we came up with Trove. And early days, Trove was still looking at their business model. They were tweaking different products and trying to figure out how to go. And we worked with them and said, look, we're getting feedback from the institutions to say, this is a problem. I think if you solve this problem and not this perhaps this problem, there might be a massive opportunity here. And so we introduced them to the larger banks. They weren't there for investing purposes, but they were there as potential client. And then they were able to work with Trove over the last
So just tell me
few
what
years.
it does. It just-in-time premium.
So as an example, you know, everyone, it's basically insurance and premium management for every asset other than financial assets. So if you have a mountain bike, you're capable of putting, you want to insure your mountain bike, but you're probably likely to pay a higher premium on the day you're going to ride it, which is the day you're going to go over the handlebars or it's going to get stolen, versus the day when it's sitting in your garage 364 other days of the year. And it allows you to sort of switch in and out of premiums in that capacity for the individual.
I mean, it is amazing how fintech solves for problems that you have that you never knew that you did have, which is kind of how, but they're real, you know, and that's what makes it.
And I think in insurance, one of the things that will continue to work is things that, insurance is an industry that it doesn't matter if you make $10,000 a year or $10 billion a year, everyone has an issue with what type of insurance they must pay for and what they feel about that insurance market. So it's a very emotional pull there, so it is a very captive audience. So I think there will be some tricks that come out of the insurance space that will work, absolutely.
It's been one of the later areas to develop in fintech, and so it would be interesting if it was one of the more promising too. It wasn't one of the ones that people naturally gravitated to out of the box. What are your thoughts on what's working and what's not? And
yeah, so if I think about fintech startups in general, they kind of fall into two categories. One is there's somebody that works in the financial services industry. They have a job. They wish they had a piece of technology to solve a problem, or they saw some structural issue with the industry. They wish it worked differently. They don't have the budget or the resources to actually execute on that plan internally. And they say, you know what, I'm just going to go start a company that solves this problem. And I think for the last 10 or 15 years, most of the companies in fintech were of that category. They were entrepreneurs that came out of the industry that saw some inefficiency or structural problem or opportunity that was not being met at their current seat, and so they went and started it. And I think the latest generation of startups are people walking around on their phone saying, hey, I wish I could just push this button and my bank would do this, or money would just show up, or my friend would have it, or I really don't want to walk into a branch right now and fill out paperwork to get this thing. Can't I just get it? And I think in those two categories, the folks that are in that first camp, they have worked for a very long time. They will continue to work. I think you will continue to see structural issues and inefficiencies in the industry solved by practitioners that are going and starting companies that solve those issues. And in the second, it's a little bit harder, right? It's hard to build a consumer brand. It's hard to finance a balance sheet with venture capital or hedge fund money versus deposit cost of capital. What they're realizing is a bank that has 100 million customers can roll out that app in a second and have the distribution that might take them 10 years to go get. And so I think you're going to see real power law distributions inside that second camp where 20 companies launch, one of them successful, the other 19 are going to be roadkill. In the first camp, you're not going to have the unicorn exits. You're going to, these are companies that'll be $200, $300, $400 million exits. And I think for the investors that understand those problem areas and have the ability to bring their organizations to the table and be early adopters, they're going to make good returns at a $200 million exit because they don't need a unicorn status in order to make money. And so I think that we continue to invest in that first category. From time to time, if we see something really special in that second category, we'll look at it. But I think that second category is going to be really challenged over the next couple of years.
so we have a question from the app. That's so new, right? We never had a question from an app before in a conference I did. It's what is the most amazing? Please send in other questions or raise your hands. I haven't seen hands go up, but maybe it's more comfortable to send questions electronically.
We don't speak to each other anymore.
We don't speak to each other anymore. We just.
Messages.
What's the most amazing unicorn out there today, in your personal opinion? And this will go to a second question, which is maybe we're not talking about unicorns in this space anymore. You can have a lot of success without them. But what are your thoughts about what is the most amazing unicorn out there, if any? Any ideas on this?
I'll try that. And for the sake of full disclosure, we invested in it because I thought it was an interesting one. A company called Adyen. Adyen does cross-border payment processing for large e-commerce and kind of that hyper-growth companies. So their clients are Airbnb and Uber, Facebook, Spotify, Netflix, Nike. Cross-border, what they call omni-channel, online, offline, mobile, all integrated on a single stack. The company,
So wait a second. If you take an Airbnb reservation like in Hong Kong, it somehow
it processes the payment in multiple currencies, brings it back, reconciles it back into especially for hyper-global companies like a Facebook, like an Airbnb, like an Uber, Netflix, Spotify, et cetera.
Wow.
So they have extraordinarily complex processing needs. It doesn't sound difficult, but most companies are otherwise relegated to working with a patchwork of local, regional merchant acquirers and processors. And there's a lot of information leakage that happens as a result of that. And Adyen is one of the few companies globally that's uniting all those activities across every currency, across every region, to be able to seamlessly do it.
And it's a very valuable company.
I think it's an enormously valuable company.
How many
Unfortunately, it's
people-
one of the few things that, it was one of the few unicorns, even years ago, from day one, it was profitable. And now it's very, very profitable. So
How many
managed
people
to
have
defy-
heard of this company? 1, 2, 3. I think it's incredible that you can have such a valuable company in a space that everybody uses if you go into Airbnb or something like that, and yet nobody really knows that it's there.
Sure. Or if you go to Nike, I mean, they do offline processing as well. But it's for those companies that have ambitions to be A, global, and B, moving to e-commerce. So you can have offline and online commerce.
I think that the point that you made earlier, John, about the service business versus the kind of e-commerce business. What people, I think, don't appreciate about this space that is unique is that you could, if you're an early stage investor, you could get into a position on a company like that and it could become incredibly valuable, but they don't necessarily need later stage money, or they're not necessarily going to be an IPO. So you may never hear of them, but they only need 3 or 4 clients to get the scale that they need, and then they're massive.
So let me ask you, how large was the first funding round for this company?
I think it was 11 million euros. The company's based in Amsterdam. They have basically co-headquarters in the West Coast. But the company was hyper efficient with their operations day one, and they still are. So they've never really even burned through that first 11 million euros.
Wow. So that must be one of the most lucrative investments in the history of investing.
It's gonna be, hopefully it's a good one. We haven't monetized it yet.
I mean, to become cash positive with an 11 million, and I guess it shows how important it is to be at a very early stage for a lot of these things. That by the time it hits, what did you say, City Ventures, or that you might be beyond. Well, how do the banks feel? Where did the people come from who created this? Were they from the traditional banking sector?
No, they were in the payment space. They created a company called Bibit, which was sold to WorldPay, which today at its core is one of the important growth drivers of WorldPay. So I think being an insider to the payments industry, they appreciated some of the vagaries of the opportunity and the challenges. And so they said, I think in hindsight, they probably regretted selling as early as they did. I mean, it had been a phenomenal outcome for them, but they realized, learning from some of the lessons from their Bibit experiences, that we're going to start this again.
So when people talk about collaboration from established firms, I don't know if they do think about contributing their employees to highly lucrative ventures that will be, but most of these people in the fintech space come from established institutions, right, with a very good idea. And I guess what is the point, that they couldn't create this in their older institutions, so they found more freedom to do it in their...
Well, I think it's indicative of what I was just talking about, where, and I love Adyen. I think it's probably one of my favorites as well. I mean, it solves a real structural problem in the industry, something that banks today are not equipped to go deliver on their own. And
could you say why? Because that seems like a quintessential service that a global bank would be able to provide.
Sure. I mean, I think John could probably talk much more about the merits of Adyen, but I mean, if you think about what it would take to, say, Facebook to process a credit card transaction in 100 or 200 different countries globally, that's a really hard process. You need to have local payout accounts, potentially the ability to accept all the different payment methods in each of those different places, which are different from Turkey to Indonesia to Australia.
But isn't that the reason you used to have a global bank to help you do that?
So you do. So, historically you would go to Chase or somebody like that and you'd say, hey, I want to accept payments all over. And Chase would say, well, we don't have anything in Indonesia. So they'd go find somebody in Indonesia and they would work with them and have them process the Indonesian payments, and then it would have to remit back to the US or to wherever it was. And you end up managing this global web of partners in order to process payments all over the place. And that's really difficult. The data is coming in different formats. You don't have really proper risk management. And so I think somebody like Adyen, who had the flexibility of not innovating within a bank, to go out and say, if we were to solve this problem today, how would we solve it technologically? They were really able to build something that's very, very difficult for a bank to replicate.
There are so many questions already. Who is for, someone's point, yeah, okay.
Success, there's a company called the Climate Corporation, which its model is fintech inside a different product. And I think it was $3 billion that Monsanto recently purchased them for. And so I'd like any specific comments about the model where a fintech play gets embedded in a different product. And the example here is Monsanto's a seed company, but somehow now they're doing insurance payments.
Yeah, so we were one of the first investors in Climate Corp when it was still called Weatherbill, and eventually was part of the team that sold it to Monsanto. That's a great example, and I think there are, in our opinion, a number of new industries and new businesses that will be built off of just the expansion of financial services generally, right? So we have a company right now that we've invested in called Kilowatt Analytics, KWH Analytics, out of the Bay Area, and they are very similar in what Climate Corp was trying to do for a weather derivatives market, but focused exclusively on the solar energy marketplace. So there's not yet been a massive financial overhaul of what will become financing of solar energy. And so those are types of transactions that we quite like in that vein, that they will, in themselves, become category inventions, and that there will be an entire industry now off the back of what these guys at KWH are building, for example.
So this is clearly a remarkable panel, because when you first asked that question, I thought, well, who the hell knows about this thing? But in fact, one of you guys was an investor. I say two things with your questions. If the question itself should be under 20 seconds, please, so the panelists can do it. And even though that was a home run question, because they should not be, yeah, that was a terrific question, sir. That was really great. Please tee up softballs if you can, so that we can get. That was, I think, almost a curve. Yeah, right here. Oh, you had a question, ma'am? Did you have a question? Were you raising your hand as well? No, you. Okay.
So a lot of the fintech startups are trying to do similar things to the incumbents, but do it a little faster and cheaper and better. If we look at other industries that have been heavily disrupted, often it's very different. So traditional media was disrupted by eBay and Google and Facebook. Have you seen that kind of left field disruption coming into finance?
I've started to see it in China, for what it's worth. Outside the United States, a lot of what General Atlantic does is outside the United States. So while a lot of the conversation thus far has been limited to what we're seeing here and domestically, which in itself is a tremendous market, some of the most exciting innovation from our perspective is actually happening in the markets outside of here. I think China potentially being one of the most disruptive and interesting in that I think Sheila earlier pointed out on the previous panel that a lot of the incumbent banks, because of their licenses, et cetera, creates a barrier to entry. China is not necessarily saddled with a lot of that same regulatory infrastructure. And so the kingmakers in China fintech are actually the tech companies. So if you're not partnered with Alibaba or Tencent or Baidu through their Ant Financial or WeBank or others, then you're a little bit on the outside looking in. Whereas maybe the corollary to, let's say, an Alibaba or others, a huge tech company, let's say Apple. Here in the US, you would think that Apple, despite their great resources, would be able to do tremendous things and completely move around the existing infrastructure. And when they chose to launch their Apple Pay, rather than building their own rails, which they very well could have been, it would have been expensive, but they certainly could have been, they opted to work with the MasterCard rails. And so a lot of the incumbents here have a much stronger position than I think people give credit for. Whereas outside the United States, and I would say in markets like China, especially where you have mobile penetration as advanced as it is, that dwarfs what we have here in the US. You have 700 million plus people on WeChat. That's an unbelievable base from which to work and launch truly disruptive fintech opportunities. And I think WeBank and Ant Financial are great examples of that.
Did you want to jump in? No.
Well, no, I mean, look, the title of today's conversation is unicorns, right, or unicorpses. But you have to think about what goes into creating a unicorn. So much of what goes into it is this sort of massive consumer focus and brand building around an opportunity that sort of takes on a momentum of its own. And we're always we're asked often, what is the Uber moment or the Airbnb moment in financial services, and will it exist? And while we are extremely positive that there will be massive transformation of this industry, you cannot compare the New York City Taxi Commission to the SEC and the FCA and appreciate that the customers driving for transparency, that are driving prices down, that make an Uber and Airbnb occur, is not likely to happen anytime in our lifetime in the financial services industry. And so this natural need to work within the regulatory regime we have, even if we're working to change it, has to be a first moment, and I think you will see less unicorns emerge because of that. There's just, you're not going to have that moment of massive momentum building around.
It is interesting. I was at Apple a while ago, and one of the questions is whether Apple Pay is important, and there are some other payment mechanisms. And the payment space is incredibly complex. I mean, if you've ever tried to understand how payments work, you're amazed by just how many steps it goes through. But there is one point where it kind of becomes orderly. There are 4 main channels in America: MasterCard, Visa, American Express, and Discover. And American Express is obviously going through some issues about its own business model. So when we were talking about Apple Pay, some people had suggested Apple might want to buy American Express. They certainly could buy American Express. And the person in Apple Pay was like, the regulatory threat to Apple was considered so terrifying that it's just, I think they just, they could go into that space, but they would do so with great, great trepidation because it might bring the rest of their business into all the things, almost as a contagion, into the rest of their business, which is a place they don't want to go. So they want to go as close as they can to regulation and then stay out of it. And you're right, the New York City Taxi Commission, but it's pretty tough if any of you have ever dealt with that. There were some other questions back here. Was there one in the back of the room? Okay, so failures that you thought would be terrific. Does anyone want to admit to having engaged in a failure?
We have a classic, and we've had multiple examples of this, and it comes down to, what is the most important thing for an early stage venture investor? It's the people. And where we've failed is sort of not backing the wrong horse, because I think we've gotten really good at judging people, but one place where we've now insisted is that we prefer co-founders. That one founder doesn't necessarily move the needle for us, and that's because of a whole host of reasons. But the businesses that we're looking at, if we come and we see somebody who's got just their own sort of sole idea, we tend to find out what it is that they're lacking and ask them to go find a founder or to bring somebody from their team in, because single founder entities have proven challenging for us.
Because why?
It takes.
I mean, you think of all the great companies, like Apple again, you have Steve Jobs, you have all these charismatic.
You're starting a company in the early stages, and in any industry, but specifically in financial services, you have to be so confident that what you have is meaningful and useful for the markets, and you have to represent that to everyone you go. So in that confidence, and sometimes hubris, you can find it hard to figure out what your weaknesses are. And so if you can't be self-aware to appreciate what you might be lacking, it's always helpful to have somebody there who can balance that out. And so it just works naturally.
I mean, in terms of very concrete, what I like and dislike in one sector or subsector is I really like lending. Yeah, we haven't spoken about that. I think it's a very natural idea that technology is disrupting how you lend, especially to consumers. So I would say like a technology company like Google or Facebook knows more about an individual, maybe even in emerging markets in Africa or whatever, than a local bank does, who have never seen the client till he walks in the office and then has to judge if the bank wants to give the client the credit or not. So credit decisions with technology,
you like?
I really like. However, if I look at the market, there are 2 business models. They are like all these who wanted or want to be peer-to-peer lending companies, like marketplaces. And I think you have with Lending Club here in America was already like the big drop. I don't like that, because I own a fully licensed bank where we look from a balance sheet perspective, because we have a lot of cash retail deposits, and we want to lend as a bank. So I looked at the whole market.
Wholesale funding concerns you.
Pardon?
Is it the wholesale funding?
But in that case, I had the cash and I looked at the models. What I disliked was that the marketplaces, there was no alignment of interest, because they were techies. So when I said, I won't name the company, but when I sat with one of the big ones and they asked them, have you ever, as a person, as the founder, lend money to somebody and not got it back? What happened to me a lot, because I invest, and he said no. I said, then you're the wrong one to build up a lending platform, because I think you should have felt the pain, and go through all of that. But positive, what does work, I own the largest online consumer lender in Africa, but we are a balance sheet lender, so we lend our own money. So we developed the technology, it's called MyBucks, but then we raised money for the company, equity, debt, mezzanine, whatever, and then we're lending out our own cash. So the people who founded the companies come out of the, one comes out of the technology space and the other one out of the banking, and he was a lender before, like a traditional one, and then
Boy, this raises such a profound issue about agency. On one level, what do you lose when your client or when your customer loses, and what do you not? And if you're a platform versus being a direct participant, and all forms of finance raise this issue, but fintech disaggregates it and puts it. You wanted to.
Yeah. So I think if I think back 2-3 years ago at another conference I attended, probably 60-70% of the startups that were in the room were Bitcoin related. I think there was $1 billion that have gone into Bitcoin startups over the last couple of years. I can't say for sure, but that feels like in a lot of zeros waiting to be recognized. So I think that that's an area that got a lot of hype and buzz in the last few years. And I think a lot of the people that have invested in that category have shifted their focus towards blockchain and distributed ledger as opposed to Bitcoin as a unit of currency. And so I think we're going to see a lot of shakeout happening there.
I'm so relieved because I never understood Bitcoin. And so now maybe I won't have to understand it. And we do have someone on blockchain later today, and so maybe I have to understand that. But these are just ideas that I've never really fully appreciated. So we have a question that's come in from the app again. Is the economic climate going to kill unicorns, or are they immune? Will we continue to see unicorns born? Let me just ask this a little bit more broadly. I care about the unicorn. It is the theme. But what will this do to fintech investing? So basically everyone on this panel, I'm sure, has a opinion on that. Should we start with you? Whoever would like to start first.
Sure. I think we're still in the earliest stages of opportunity around here.
But will the economic climate affect?
I think, look, by definition, financial services is cyclical, no doubt about that. I think one thing it's a profound impact is the funding environment. I think that for sure has happened, and is beginning to happen. And if we go into recession, for sure it's going to happen, where a lot of kind of half-baked ideas were getting funding. I think for a while the IPO market was receptive to hugely unprofitable fintech unicorns that had unproven business models. I think those days are long gone. I think there'll be a lot more shakeout than not. I do not see a lot of M&A happening in the space where traditional banks will be buying up fintech companies. I think goodwill makes it too difficult from an accounting point of view. And also, it's not clear to me the buy versus build is so compelling that buying a unicorn at $1 billion or $2-3 billion, what you could potentially build and make it industrial strength or something like a Chase or others, not entirely clear to me that. And I think that would be exacerbated by a slowdown in the economic environment. I still think, though, you're in the earliest days. You've got, some stats I've heard is 72% of millennials would rather bank with a non-bank, Apple, Samsung, PayPal, et cetera. And banks, unfortunately, are some of the least trusted brands in America. You've got, in Europe, you've got huge ailments facing their balance sheets, and they just are completely stifled on their ability to innovate. And so I do think, yes, unicorns will continue to be created. I think Amy's right. There are probably few of them in the U.S. I do think there'll be a lot, to my comments earlier, will be outside the United States. And I think there'll be a real shakeout coming. And to Pete's point, I think there's going to be a lot more zeros than not for the recent vintages.
We have 2.5 minutes left, so if each of you could take like 30 seconds on that question.
No, I agree, so we can make it quick. Yeah, the only thing I think there is this obsession with unicorns, which I don't share.
Yeah, okay, so let's broaden it to say, is the economic climate going to kill or undermine investing in fintech, either from the funding point of view or from the creative point of view? Your thought on that?
I think it's neutral. Yeah.
Neutral.
Yeah, I think we're absolutely just at the beginning. We've always talked about this space as evolutionary, not revolutionary. And I think the one fantastic thing that's happened in the last few years is that everyone in the industry appreciates that this is the way we're going. And if we do our jobs correctly, all of us, there will be no more fintech sector in 10 years. It will be financial services, and it will be re-engineered on the back of technology. I do think, though, there's will be a massive trend towards consolidation and roll-up. I think you'll see a lot of startups starting to combine with each other where they can see complements.
I agree with what everybody said. I guess we started our fund in March of this year, and so I'm pretty happy to be investing into this climate because I feel like having capital and the ability to be opportunistic when valuations are pulling back, there's less people putting money into the space. It's a really good place to be setting my marks as I start putting money to work, and so I'm actually happy about it.
So one thing that I sometimes recoil against is everyone says, well, when there was a lot of money, people just did stupid things, but now there's less money, so we'll do smart things. And I'm wondering if any of you have ever invested in an idea in fintech space, we only have a couple, that seemed to be really stupid to many, many people, but actually turned out to be a very, very clever idea. It would have been a really contrarian take.
We deliberately ignored Bitcoin when everybody said go Bitcoin. We said no, and we found blockchain companies before anybody knew what blockchain was, so that worked out.
You never found anything.
You never found anything really surprising that was.
In other sectors, not in the. I just don't. I would say I missed the erotic train totally, like 2000. All these when all these chat lines were like, this was a big thing in Europe, like where people were calling hotlines, whatever. They were big companies created, and I missed that when I looked at it in 2000. I remember that, because I didn't use it myself, and I was like, who is going to use that, And then there were so many people doing these chat lines, and but not in fintech actually.
Well, I think the one thing you guys, you mentioned that in your, when you choose a CEO, you have to have someone who's very, very confident, to advance it. And of course, for yourselves, you have to be very, very confident when you do those things because you're sifting through things at a very primitive stage. And I think that's a very, very challenging thing to do. And I guess you get a report card in 3 years or something is your, what is the time frame by which you expect some result?
I think we each invest at different stages, so I think you have a better sense. But you know within the first 12 months if your thesis is largely in line. Now, we don't monetize in a year, but you have a general sense as to whether or not your initial thesis is getting the traction you hoped it would.